What's going on, guys? Welcome back to another video. In this video, I've got another incredibly important AMC update to bring all of you this Sunday afternoon. So what we're going to be going over in this video is a really important proposed rule change that is going to be coming into effect over the next couple of weeks. What this is going to set off is a series of automatic margin calls every single day. This is going to be very important because we are essentially going to be able to suck the liquidity out of all of these different institutions to the point that they may have no choice but to cover their short positions or sell off their long positions that they are massively over leveraged in. And there's also a couple of very key important things that I want you guys to be aware of going into the next week. So before we get into all of that information, if you guys enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps me get this information out to as many people as possible. And the more people we get learning about AMC in this entire situation with accurate information, the stronger our community becomes. So the first thing that I want to go over is the option chain going into next week. There's two very important things that I look out for when examining the option chain when I'm looking for a possibility for another gamma squeeze. Over the weekend, yes, open interest is important, but what really gives us a hint about what we are going to see going into the next week is these volume numbers over here. And here is why. So the volume is updated throughout the day on Friday, and we do not actually know if these actual contracts right here, sorry about that, if these actual contracts right here are actually going to be counted into the open interest or not. If all 42,000 hypothetically of these contracts were bought and are being held in people's brokerage accounts, then we would see this open interest on this $50 strike massively spike up. We are seeing the same thing with this $60 strike right here. We are seeing a pretty high volume as well with this 55 and with this $65 strike. So we are seeing a possibility for the open interest to skyrocket when Monday, the market opens on Monday, which could lead the way for another gamma squeeze. Now, the second thing that I want to bring to your guys' attention is that Ortex is reporting that there were 33.5 million shares. We have gone over this in all of my previous videos, but this is something that you need to understand. The way Ortex gets their data, them reporting their data like this is not their fault at all. It does suggest that shorts are starting to cover, but the key thing, the simplest way to look at it is look at the shares on loan right here, 138 million. Now we look at the percentage of the free flow on loan, 27%, but the estimated short interest as a percentage of the free flow is only 17.45%, meaning that a lot of these shares that have actually been loaned out have not actually been sold to create a short position. So these institutions could basically take a loan of shares, not sell them, and then just return them in bulk all at once to make it look like there is a massive wave of covering, which is not actually there. They can also use some advanced option strategies, but we are not going to cover that in this video because it gets very complex and we have already covered it. The second thing, you guys need to be very prepared for when we get these proxy materials to vote. Voting is incredibly important. If we actually vote and it comes out that AMC receives more votes than are actually supposed to be in the float or these shares outstanding, that is going to give us a lot of proof and it is going to confirm a lot of our theories that there is some blatant and aggressive naked shorting going on. Now, before we get into these automatic margin calls, I want you guys to fully understand what a margin call is. So a margin call occurs when the value of an investor's margin account falls below the broker's required amount. An investor's margin account contains securities bought with borrowed money, typically a combination of the investor's own money and money borrowed from the investor's broker, essentially a loan. A margin call refers specifically to a broker's demand that an investor deposit additional money or securities into the account so that it is brought up to the minimum value known as the maintenance margin. A margin call is usually an indicator that one or more of the securities held in the margin call in the margin account has decreased in value. When a margin call occurs, the investor must choose to either deposit more money in the account or sell off some of the assets held in their account. So it's essentially saying, hey, the value of your position has decreased. You have less equity in this account than you previously did, and we're going to need you to deposit more money. So now the exact proposed rule change that we are going to be talking about is going to be NSCC 002. So we're going to get into the dates in a little bit, but I want to go through some of the language in this actual filing to make sure you guys fully understand what is going on. So the proposed rule change consists of modifications to Rule 4A of the NSCC's rules and procedures to calculate and collect, when applicable, supplemental liquidity deposits to NSCC's clearing fund on a daily basis rather than only in advance of monthly expiration of stock options. If you guys have paid attention to some of the key points of my previous videos, we have seen the failure to deliver numbers spike around the expiration of these monthly options. Now, the reason for this is that there's typically more open interest, and it's going to be a lot harder for these actual institutions selling you these options to actually cover the amount of contracts, but that gets a little bit involved. So when we come down here, we can see that the second thing is they want to establish an intraday supplemental liquidity deposit obligation that would apply in advance of options expiration activity periods and may also be applied on other days as needed. Implement an alternative pro rata calculation of members' SLD obligations that may apply in certain circumstances, and simplify and improve the transparency of the description of the calculation, collection, and treatment of SLD in Rule 4A of the rules as described below in greater detail. Now, here's where this gets really interesting. They're actually preparing for a massive wave of defaults of their members. So when we come down a little bit further, we can see NSCC, along with its affiliates, the Depository Trust Company and Fixed Income Clearing Corporation, maintains a clearing agency liquidity risk management framework that sets forth the manner in which NSCC measures, monitors, and manages the liquidity risks that arise in or are borne by it. We can see here, if a member defaults, NSCC needs to complete settlement of guaranteed transactions on the defaulting member's behalf from the date of default through the remainder of the settlement cycle. As such, and as provided for in the framework, NSCC measures the sufficiency of its qualifying liquid resources through daily liquidity studies across a range of scenarios. This is very, very important. Now, here is when we get into the actual dates that we could see. So this is going to be an amendment or an update on this NSCC 002. We can see here that they are essentially saying the commission shall either approve the proposed rule change, disapprove the proposed rule change, or institute proceedings to determine whether the proposed rule change should be disapproved. The 45th day after publication of the notice for the proposed rule change is effectively May 7th, 2021. The commission is extending the 45-day period for commission action on the proposed rule change, and the new date is going to be June 21st, 2021. So, when we see this language, it has already been delayed once, and we are now seeing it come up on June 21st. Over the last week with AMC, we saw some very interesting things happen. I have been made aware of some people trying to exercise their options, and typically it takes T+2 to actually receive delivery of those shares, and people actually have not received those shares, which means that there is a possible liquidity problem going on, that they actually can't go out and buy these shares, or two, they can't even get their hands on the shares because there's no shares left. So it is entirely possible that NSCC 002 gets delayed again, but I am hopeful that we are going to see this get approved on June 21st. Now, the NSCC is the National Securities Clearing Corporation. So when we take a look at this Excel spreadsheet, these are all of the members, and we can see by this block right here that there are 3,464 members. Basically, everybody is listed as a clearing member. So everybody is going to be subject to this new proposed rule change that is going to be the daily update on the margin requirements. This is extremely important to note because they're all involved right now. The NSCC knows, all of the regulatory institutions know what is going on with this over-leveraging situation. Now, this isn't the first time that we have seen something like this. We have seen NSCC 005. We can see here, based on the backtesting results discussed above, when they were essentially determining whether $10,000 per member was going to be the correct amount, they have decided to raise the minimum required fund deposit amount to $250,000. They are looking and preparing for a massive wave of defaults. Now, something that I also want to note is that we are now really close to that June 21st date. And what have we seen over the last week? Goldman Sachs, Bank of America, Citigroup, and Jefferies Financial, along with Raymond James, have halted short sales of AMC, Microvision, and GameStop. Now, these different institutions, when they loan out shares in order for their clients to short it, they are bearing a pretty significant risk if their client is not able to return these shares. We have seen some evidence of a lot of naked shorting going on in the market. And the fact that Goldman Sachs, Bank of America, Citigroup, Jefferies, and even Raymond James are turning off shorting ahead of this proposed rule change coming in that is going to essentially say, hey, we need higher collateral requirements like we are seeing right now. This is getting extremely interesting, and I believe that we are in crunch time for the mother of all short squeezes. So I know that a couple of these filings that we went over are very complex, but here is a brief summary that I want you guys to understand. Every single day after this is going to get approved, we are going to see an automatic calculation of which members are over-leveraged or are under their minimum required deposit or the minimum amount that they need to maintain in these margin accounts. If that does occur, they are going to be forced to either deposit more money into these accounts or add securities, as we discussed before, or even close out their positions entirely. This is a very big sign, and it is a step in the right direction, in my opinion. So that is going to conclude this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people as possible. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great weekend, and I'll see you guys in the next video.